Are you able to see my screen?
Yes.
How about now? I want to know if it goes away during presenter mode.
Yes, I can see it.
Okay. All right. Let me know if it's too small or it starts messing with the ratio of the screen, because I have a huge screen, and sometimes when I do presenter mode, it makes it like extremely tiny. So just make me aware of it.
Looks good, Oz. Looks good.
Okay, good deal. Well, welcome everybody. This is my name is Oz Salinas. I am the owner and branch manager and operating loan officer at Mortgage Pros. We are a mid-sized mortgage company, direct lender through Fannie Mae, Ginnie Mae, and Freddie Mac. We do every loan type product out there, with the exception of raw land financing. We do anything that has to do with purchasing a single family residence, a second home, or a non-owner occupied property that could be 1, 2, 3, or 4 units. So this is going to be the basics of mortgage financing. Now, this is where we try to give you as much information as possible to make you an educated real estate agent, but this is not this doesn't have the intent to make you, you want to know just enough to get yourself through the conversation of your buyers whenever you're interacting with the buyer interested in financing or purchasing a real estate property. Majority of the times you're going to run into that interaction of conversation with that has to do with financing, right? So I want to give you enough knowledge for you to be able to educate yourself and have an educated conversation with these buyers, but not enough that I want you to do my job, or not enough that I want you to get in trouble. So you only want to know enough to carry yourself in an educated way with your buyers, and that will have the main purpose of this training. We're a local lender that operates out of McAllen. We have 12 loan officers. We have a local team that is here to support you in any possible way. And I'll start by talking about the loan application, right? And all this information will have a double perspective. One is going to be the lender ourselves. What do we do? How do we interact? What information do we need? How do we go about getting these borrowers, these clients of yours, pre-qualified, eligible to purchase and finance one of these properties, so that you can confidently go out there and wisely invest your time in these individuals that now it's a fully pre-qualified borrower, that it's a reality for them to be able to purchase this property, right? The last thing you want is to spend a lot of time, effort, and energy in clients that don't stand a chance or have no seriousness of purchasing a property. So our job is to become part of your team. Our business model at Mortgage Pros is to create joint ventures and business relationships with our real estate agents. So I preach to every single one of my loan officers to create a team environment, a support environment with the real estate agents, because in the end of the day, that's really what we do. We're here to support you and your business. You're trying to build your business, trying to create more transactions. And the only way that you're going to be able to do that adequately is by having a proper support team. And one of the most important and most crucial positions of that team that you need to form is going to be the lender. You need to have someone that is reliable, that has ethic, most importantly, that is going to be there for you and your clients to help them pre-qualify and get approved for the purchase of a home. So without going into too much detail, I'll touch upon the subject of application taking and the process of it. The first thing is we want to talk to the individual, right? So you're going to get us a name and a phone number of a client that you have spoken to, or somebody has reached out to you with the intent to look at a property, whether you decide to show property before or after our conversation or our interaction for pre-qualification with the client. that's going to be a decision that you must make on your end. You're going to have to be able to dictate how you structure your purchase process or your interview process with your clients. My suggestion is you give the client enough time and enough attention to allow us to have an application taken and give them the respect and the benefit of the doubt that they do have the intention to purchase, so that we can come into the picture and then take information on an application and then come back to you and say, this is a legitimate person, this is someone serious, or the opposite, right? Someone that tells you one thing, but when we speak to them, they have the total opposite intent. They're not serious. They're not really intending to purchase. They just wanted to see the home, or they just simply don't qualify, right? So going straight into the application. So when we talk to a buyer, what do? What is the conversation like? We want to know about 4 major components: is their personal information, their employment, their income, and their assets. Those are the 4 factors that determine an approval for financing, for mortgage financing. So personal information, what kind of information? Name, social security number, date of birth, and the address in which they currently reside. That allows us, the personal information allows us to pull a credit report and determine if this individual has sufficient credit to be eligible or considered eligible for financing purposes. So that number 1 is the most important, because if we collect this information, we pull a credit report and we pull a credit score of 500 score, we don't even need to get into the details of employment, assets, income, because none of that matters. If you don't have the credit required for approval, none of the rest matters. You could have 90% down payment to purchase this home almost cash, but they're missing 10% and they need financing and they don't have the credit required. We can't qualify and we cannot help. So what we try to do to expedite the process with our clients is we try to pull credit immediately to know scores, eligibility, and then second, we continue to obtain employment history. We need history of employment for 2 years. For different reasons, and that I don't want to get into because it gets too technical, but most importantly, just know that the customer has to provide us with a 2-year history of their employment. Income type, it's very important. Is it a salary individual? Is it a 1099? Is it someone that is a self-contractor? Is it someone that is self-employed? Have they had changes of employment? So we look at income type with a very fine comb. And then the sourcing of funds for closing, that's the assets. Do you have money to purchase this home? And do you have it properly sourced or properly sourced, right? Is it sitting in a bank account that belongs to you? In our area, it's very common for people to have money under the mattress. The mom has it in their home. My cousin owes me money. So none of that is actually going to be worth our while. We have to make sure that the funds are being sourced properly. So they have to sit in a bank account for 30 days under the customer's name before we can consider it a stable or sociable fund of asset. So as far as pre-qualification, so the pre-qualification versus pre-approval, right? This is something that comes up in conversation a lot of times. What is the main difference? Well, pre-qualification is just number 1 of the 4 factors that I just talked about: name, address, social security, date of birth. I pull credit, you tell me employment, income, and assets, you put it on or you give it to me verbally, and based on that information, you're pre-qualified. It's all the factors of an approval, but without the verification process of it. Pre-approval. What is pre-approval versus pre-qualification? Is going the step, the additional step of the way to verify this information. How do I verify this information? Through different documentation. We need your ID and your social security number to verify your personal information. That's going to give me your name, date of birth, address. So I verify that. Your social security card, it verifies your social security number. Your paycheck stubs verify your employment and your pay rate or income, and your bank statements give me the ability to verify or source the funds for the transaction. And I missed on income, it's going to be pay stubs or in W-2 forms or paycheck stubs and tax returns. Depending on the income or employment type, it's a type of document we'll require. Majority of the time, for someone that is an employee of a company that they don't have ownership of, or they don't, it's not a family-owned business, is going to be paycheck stubs and W-2 forms for the last 2 years. Okay. So once we verify this information with documents, now it turns into an approval or pre-approval. That allows me to give you, real estate agent or Mr. Buyer, a letter stating that you're now eligible for approval. All we need is the property under contract so that we can begin a formal process to take this loan into processing, underwriting, closing, and funding. So what do we look at when we're doing this information or obtaining this information from the customer? We're looking at credit scores, obviously, as we determine the amount of debt that is on credit and the amount of income that I have on paycheck stubs. Then I determine debt ratios. That tells me if the customer is eligible for financing based on ratios. Every loan program has different requirements for debt ratios. And just to give you an idea, depending on how new or experienced you are in financing or real estate, debt ratios is basically the amount of debt or liability versus income that I'm using for qualifying purposes. So we have 2 debt ratios. You're going to come into a lot of conversations that have to do with ratios. Some lenders may tell you that the customer is exceeding allowable debt ratios. It's just that they have too much debt, or they're trying to borrow too much against the income that they have, that they receive on a monthly basis. Budgets and estimates, we talk about how much on the pre-approval, how much do they qualify for, what is the monthly payment of a home that they're intending to look at. If it's a $200,000 property, we want to give a monthly payment. We run into this a lot. We pre-qualify a customer, they're looking at a $350,000 property with the agent, the very first property, they want to see it. The agent calls us, hey, this customer is intending or wants to look at this property. Do you mind helping me with a pre-qual? We talk to the client, we have a conversation, and one of the most important things we cover is budget. How much do you have in the bank to purchase this home? And number 2, what is your budget for monthly payment? Majority of clients come back to us and say, I want to pay $1,000 a month, no more than $1,200 a month, $1,500 a month. And that's perfectly okay. That is telling me the comfort area of the customer, different than what their capacity may be, but most importantly, that's the range in which they want to be within as far as monthly payment goes. So I don't want to go and tell this customer that they can go and look at a $350,000 property. I'm going to tell this customer to come down to earth, and the monthly payment on $350,000 is going to be $2,300 with the taxes and insurance included. Is this something that you're willing to accept or willing to compromise to 30 years in order for you to purchase this house? And their answer is going to allow me and allow you to be more efficient at what we do. You don't want to go and show a property at $350,000 if the customer has only the potential to get approved for $250,000. So this is extremely, extremely important in the process of efficiency for real estate agents. Carry a very solid relationship with the lender that you trust, and it's someone that is reliable, that is going to go the length of the way and be very thorough on the pre-qualification or pre-approval process of your clients, because it could go both ways, right? It could be someone overly aggressive that is trying to get a customer approved for that $350,000 home that they want to buy, but their numbers are just simply not there. So they're trying to stretch that dollar, that income, as much as possible to get them into that $350,000 home, yet they're just simply not approved, and they can go under contract, get appraisals, inspections in the middle of the process. The income analysis just doesn't support it, and all of a sudden we have an issue. We can't get that $350,000 approval anymore. We can only do $315,000. Well, all of that should have been done at the pre-approval stage before allowing a customer to put any money on any contracts, or even before, in my suggestion, I wouldn't even allow someone to go and look at a $350,000 property if their budget for approval is only $310,000 or $315,000. So that is really the big difference between pre-qual and pre-approval. You always, as a real estate agent, if you're getting someone that is already pre-approved, comes with a pre-approval from their bank, their lender, you want a pre-approval. You don't want a pre-qualification. So always ask that question. Have you verified income and assets? Have you verified employment, income, and assets? If the answer is no, if you don't have it in writing, then hold off. Make sure that they go through that verification process. Questions? I want to make sure that I give you enough opportunity to do this, enough opportunity to ask questions. Are you guys awake? Sleep? Give me a
That's the
sign.
way I feel sometimes.
So just give me a sign that you're awake, all right? Let me know if and I want to make it, an interactive. One of the benefits of doing a short group, which is, like we do now, is to allow you to ask questions that sometimes you may be a little bit intimidated to ask because there's too many people in the room and it might sound like a stupid questions. So just feel free to ask, whatever I can help you understand better. That's really the main purpose of this training. Okay, don't feel like this is a formal training that we just have to sit and listen to random do for us. So anyway, okay, moving on from the pre-approval process. We talked about the verification of the data, right? We get the information. How do we verify it? This is the information request. I mentioned already, ID and social security card, the most recent 30 days of paycheck stubs, the last 2 years of W-2 forms or tax returns in the event that they are self-employed or work for family members, and the most recent bank statements. And majority of occasions, we ask for 2 months. Certain loan programs allow us to do one single bank statement. Loan programs, these are the loan programs that you're going to run into the majority of the times. It's going to be conventional financing. Conventional has 2 major agencies, so you're going to listen or hear about loan financing through Fannie Mae or Freddie Mac. Those 2 agencies are conventional financing. That's conforming conventional financing. FHA is the Federal Housing Administration. It's a loan only specific to owner-occupied property. Don't ever get it confused to be a first-time homebuyer loan program. This is not a loan specific for first-time buyers. It could be a second home buyer. It could be a third home buyer, a third home buyer. So it's just for owner-occupied. You cannot buy second homes. You cannot buy investment properties. It has to be owner-occupied for FHA. Reasons, VA, it's the Department of Veteran Affairs. They must be eligible for VA financing, meaning that they have to live in the property and they must be a veteran. So that's a requirement for VA. In Texas, we have an additional incentive for veterans, and that's the Land Board Department or Department of Land Board, which is the Texas Vet. Okay, the Texas Vet has additional incentives on, it's kind of similar to down payment assistance because they dictate their interest rates. However, they have additional fees. So the Texas Vet loan is really beneficial for fully disabled veterans. They have an extremely low interest rates that even with a higher fees, it's very attainable to, or very, the incentive is very attractive to disabled veterans. So we do that as well. And then USDA financing is rural financing, right? Department of Agriculture. Conventional financing, I'm going to run through these very briefly. Again, I don't want to go too deep into this because I don't mean to confuse you. I just want to give you enough to have enough data to have enough information for you to understand and have an educated conversation with your buyers or lenders that you may run into. So a conventional loan is going to be a loan program that requires a minimum credit score of 620. The down payment, it does allow a reduced down payment for first-time home buyers, which is 3%. A standard down payment for conventional is 5%. Total debt ratio, it allows up to 50%. The biggest benefit of a conventional loan is that mortgage insurance is waived when the customer puts 20% upfront, or if they put 5, 10, 15%, any amount less than 20% at closing, and then they have mortgage insurance in their loan, excuse me, the mortgage insurance has the ability to be removed when the customer accumulates a 22% of equity. No longer 20% because they didn't do it up front, but as long as they accumulate through the reduction of interest or principal through the repayment of the loan, when they reach 22% of investment into the deal, then they can remove mortgage insurance. The variable mortgage insurance, it means that the better the credit score, the lower the higher the down payment, the lower the mortgage insurance will be. And most importantly, there's no upfront mortgage insurance premium. This is a comparison to FHA that has a high upfront mortgage insurance premium of 1.75%. So I'll give you an example of somebody that's buying an FHA or buying a property and they elect to do FHA financing on $200,000. The upfront mortgage insurance premium will be $3,500. So the deal with the mortgage insurance is that the upfront mortgage insurance is basically a one-time standard fee charged to the borrower, but financed into the loan. So a lot of buyers don't mind when they go FHA because they don't truly feel the pain of paying the upfront mortgage insurance premium because it ends up being financed. However, it's definitely a hefty fee that tax, gets added to their principal balance of the loan. So conventional is usually the best long-term loan option for someone with good credit, has decent employment, debt ratios in line. This is the best loan program long-term because they have the ability to remove mortgage insurance, and it's just simply the best loan option out there. Doesn't mean it's a better loan program, it's just better long-term for specific clients. So you don't want to tell people, well, why don't you go conventional, or why are you going FHA? Conventional is better. That's an incorrect statement, because there are clients far more suitable for an FHA loan than a conventional loan. So don't make that assumption just because I just said that. Seller concessions, this is something very important that you guys will deal with a lot, is conventional will allow 3% of maximum contributions from the seller to the buyer's closing fees on a single family owner occupied property. It can go up to 6%. The more money they put towards down payment, the more concessions they can receive, up to 6%. But on a regular 5% down, single family, owner occupied, it is capped at 3%. FHA, it's the flexible loan option. It's not a first home buyer loan program, and that's a myth. It's a loan program that is flexible enough to be more friendly for first-time home buyers because it allows them to purchase a home with less money out of pocket and has far more flexibility of approval, meaning that it allows for lower FICO scores, and it allows a customer to come in and purchase this home with less money out of their pocket. That's what FHA is known for. The credit score requirement is 580. Minimum down payment requirement is 3.5%. The total debt ratio allowed under FHA guidelines is 56.99% versus 50% on conventional. The upfront mortgage insurance I just talked about, it's 1.8. That's incorrect. It's 1.75%. The monthly mortgage insurance, it's 0.85%, and that is a fixed fee for the entire loan on certain loan structures. So when they put 5% or more, they can get rid of mortgage insurance after 11 years. But on a standard, typical FHA minimum down, the MI is fixed for the entire term of the loan. It does allow for better interest rates, lower interest rates, and the reason why FHA is a better price loan program is because it has far more security for the investor, because it's a federal agency and because of the mortgage insurance fees. So they'll have a mortgage insurance that protects the investor for a longer period of time, and it's backed by a federal agency. So it's not like they can go bankrupt overnight. So anybody servicing FHA deals, that is a reason why they have better rates. And a 6% seller concession, meaning that the customer can obtain a 6% credit from the seller to cover the entirety of their closing fees and escrows, as long as that seller concession does not reduce or covers down payment required funds. So that concession has to be capped at the amount of fees and escrows that the customer has to pay on top of the down payment. The down payment has to be covered by the customer out of their own pocket, or it could be a gift. It could be funds from an agency, a state agency, or a gift from a family member. And there's a list of allowable family members that can be, or allowable donors, I should say. VA, it's veteran eligible only, so you must be either or previously enlisted in the military forces. They have to have eligibility. They have to have a minimum credit score of 580 now. It used to be 600. Now it's been reduced to 580. The benefit, it's a really great loan program. So whenever you're dealing with a veteran, you want that veteran to go VA. If for some reason their credit is extremely low, we can't get an approval, then we'll push them to a conventional or FHA loan. But the first thing is we always want veterans to go with VA financing because it gives them pretty good incentives. They don't pay mortgage insurance. That's the most important one. They can finance 100% of the cost of the home. They do have a funding fee if they don't have any disability. So it could typically 2.33% or 3.6% when it's a subsequent use. If they use their VA entitlement before, they sell that home and now they're using it again, their funding fee is going to be higher on subsequent uses. Strong credit and high debt ratio. So VA does require credit to be stable, and it does allow for much higher debt ratios to the point that they don't have a limit. They could, as long as we obtain an approval, the system verifies her approval, then we can go as high as the system allows. I actually did a loan with 76% debt to income ratio once, many years ago. It always stuck in my head because that was just insane, right? But anyhow, that's not the typical. And it does allow for 4% of seller concessions. This is one tip that I'm going to tell you, and I want you to, if you can remember anything out of this training today, keep this in mind, and it's going to be so beneficial to you as a brand new agent. VA, and if you guys were signed on when Mac and I were having a conversation, I talked about non-allowable fees. A veteran has a set of fees that have to do with financing that the VA loan will not allow them to pay. It's a set of application. There's a set of administrative application. I can't recall all the fees, but they add up to $1,200 to $1,400 depending on the lender. Those fees cannot be covered by the veteran. So if you're in a transaction in which you're making an offer on a property with VA financing, make sure that the listing agent understands that VA has non-allowable fees. If there's no concessions, either the lender or the listing agents or the buyer's agent is going to have to cover that set of fees. So you always want to have the conversation up front and not in the middle of the process that who's going to be covering non-allowables, because it could, put your transaction in jeopardy. So now if there's concessions in the deal and they're higher than $1,400, then you have nothing to worry about because the concession is basically going to cover the non-allowable fees. So this is, again, just something that I want you to keep in mind. Anytime you're dealing with a veteran and you're making an offer, keep in mind non-allowables. Who's going to cover them, or do I need to worry about them? Is there concessions? Always keep that in mind. USDA financing is rural financing, property that sits outside of city limits or in underdeveloped areas. There's mapping for USDA. So USDA requires two eligibility requirements. One is income and the other one is location of the property. There's zoning. So if you're trying to get someone pre-qualified and they're buying in real, we'll probably look at USDA financing to see if we can get this borrower with USDA financing. But it's got the benefits of low mortgage insurance. It's got 4% seller concessions available, and it does have very friendly rates again because it's backed by a federal agency, which is the Department of Agriculture. Down payment assistance. These loan programs were actually, let me correct that. This is not a loan program. We already covered loan programs, which was conventional, FHA, VA, and USDA. Those are loan programs. Down payment assistance, these are just assistance programs that get added on to the financing of a conventional or FHA borrower, meaning that the customer has to get approved for their FHA or conventional financing. They don't have funds to purchase this property, so we can go and look for assistance for the borrower to obtain the assets to close on this home, as long as they meet income, credit, and employment requirements. We can always go to state agencies to see if they're eligible for to obtain funds for transactions, right? The two major agencies, there's more than that, but the two major is TDHCA and TSHAC. We call it TSHAC and TDHCA. They do have eligibility requirements, like I said. They need to meet a minimum credit score requirement, and gosh, I don't do many DPAs, but I want to say a 620 at this point. Income, they have to meet income restrictions. They cannot earn too much on the household because then they're not eligible for this assistance. And the most important thing for you guys as real estate agents is use it as a marketing tool. You want to work with somebody that gives you the more availability of funds to your clients so that you can in return go and market this to any leads, any clients, any friends, any family that you know of are interested in buying, and they tell you, man, I wish I had some funds because I would go and buy a house today. Well, you know what? Let's get you in a house. I got, we can get with Mortgage Pros, and one of these loan officers are going to help you to get approved for, or let's see if you're eligible for down payment assistance if you're serious about this. So you can have that conversation when any client tells you, well, I want to buy a house, but I'm going to wait 6 months because I need to save up. Well, what about, talking to my lender and, have a conversation with him, with her, take an application, see if you're eligible for down payment assistance funds. There are some state agencies that help first-time buyers, purchase homes. So why don't you just have that conversation, and then we'll see if there's a possibility for you to purchase a home now rather than 6 months. So that's something extremely important for you, new agents, that you're trying to get yourself out there in the market and differentiate yourself than the competition. There's a huge influx of real estate agents. So you have to find out a way of setting yourself apart. How can I be of value? How can I be, a more of an educated real estate agent for my leads, for my buyers, so that they can choose to work with me versus the 10 other agents that are calling and dialing their phone number because they're, whatever, they're doing Zillow advertising or whatever the case may be. But anyhow, this is an extremely important factor for marketing purposes to a new agent. So if you guys want to find out more, we have marketing materials that we can put together for you guys, and you can share on social media, you can share in print, etc. So let us know, and we'll be more than happy to assist with that. The way we do business as a mortgage company is we go about it the Mortgage Pro way. What that means is we're a relational mortgage company. We look for real estate agents. We want to do business with you. We want to set up an appointment and get to know you personally ask you questions. What is your long-term goal? Are you looking at this as a business, or are you trying to just, get your hands because whatever, your husband is a developer or a builder and you get clients all the time? So we try to build a long-term business relationship. And what that means is we try to be a support, we try to create a business plan, we try to become a valuable part of your business so that we can grow loyalty together. You're going to have many choices of lenders to work with, but what are you looking for in a mortgage lender to allow you to become a better real estate agent? We look at it from a different perspective, and we feel that if we're going to be building a relationship with a real estate agent, we better bring value to the table, because we don't want to come to you and just ask you for your clients, for your business, and don't provide anything in return other than service. We understand that service, it's standard. It has to be provided in order for me to be in business with someone. So what else do you bring to the table that remains, that keeps it ethical? And that to us is building a business plan, building a relationship that allows us to help you grow, through different methods, right? Marketing, support, advertising, loan program, advertising and marketing, etc. So we try to become a huge and big support of you as a real estate agent to help you grow, because if you grow, we and our relationship will grow eventually. We take the common sense approach, which is what I just said, is we want you to grow as a real estate agent. We're there to support you to grow, because again, if you grow, our relationship will grow. We're based on knowledge and experience. We have an average of 12 years of experience between our loan officers. So we are basically experts in mortgage lending. We know our guidelines, we know our loan programs, we know our processes, versus your typical local banking that has entry-level loan officers that have, or not, I shouldn't say just local banking. I think that is a standard nowadays in today's in real estate industry or mortgage industry, because again, we just like the real estate industry right now has a lot of new people in the industry. So do we have that experience as well. There's a lot of lenders that are coming into the arena, and not that anything negative to somebody new. I mean, there's a lot of positives to that, but we pride ourselves in the amount of time that we've been in business, and the experience that we bring to the table is what allows us to be an extremely reliable lender for you guys. And we have a local team underwriter. Makes a huge difference for us, because we have someone to interact with and someone that helps approve our loans in a very consistent and fast approach. And resources, we have a ton of resources. We have our website, we have our loan app. We now these days, the pandemic changed the way we live in general, even the business type of activity that we do. We start our loan conversations and loan applications on the app, on technology. We just do a quick call, introduce ourselves, and the first step is download my app, submit an application, and I'll call you right back. So we rely heavily on new technology to become a more efficient mortgage company. And that is the end of my presentation. I'm sorry if it's just too much information. I hope that it was beneficial and it brought some type of value to you today. If you guys have any questions, please let me know. I'll be more than glad to answer any of them right now. Even if it has nothing to do with the content that I just covered, let me know. I'll be glad to answer any questions you may have.